This is nothing new in the story of leverage. And so in every cycle, what happens is various actors, companies, take on more and more aggressive positions using leverage to goose returns, which is age-old. It works. It definitely works. Now, what you're going to find in this situation is many crypto operators, particularly lending platforms, have never operated it with such volatility before. So they were in the slow growth from Bitcoin, almost a decade ago, from $800 all the way to 60,000. And all along the way, some of them became really aggressive in using leverage, which is the traditional hedge fund model. Now, what happens, and this happens in equities, it happens in bonds, it happens in real estate, it happens in crypto. Crypto's the Johnny-come-lately new asset class with a whole lot of newbies in it. You're going to see a whole series of these actors get crushed to zero over the next few months. In the contagion of leverage being caught offside with the lack of liquidity. Voyager is not that big a deal. It's kind of irrelevant in terms of, this is a diversified shareholder base. It's not FDIC insured in any way, so it's not putting any stress on the government systems in any way. All the shareholders should consider themselves educated, no different than when you go to Las Vegas, put it all on black, and it's red, you lose.
Bitcoin broke a key resistance level, making investors believe there is a future upside. Hello and welcome to Money Talks. In today's video, Shark Tank investor and popular crypto enthusiast Kevin O'Leary updates about the ongoing volatility in Bitcoin and other cryptocurrency markets, reasons behind major collapse and bankruptcy of crypto companies, and why leverage is an important factor in crypto investment. He also discusses the key factors behind Bitcoin's price performance, regulation in crypto, and his thoughts on stablecoins. Make sure to stick around to the end of this video where Kevin O'Leary reveals the important do's and don'ts of investing in Bitcoin and other cryptocurrencies. So without wasting any more time, let's dive right into the video.
That's exactly what's happened here. But the great news about this and why this is so good for the market and how this helps the crypto market is it educates the business models that aren't going to work. So it's like taking a big spatula from the sky and scraping all the crap out of the market. And it's going to happen very, very quickly. So anything that was built on a business model that is not going to work or can't sustain volatility is going to be gone. And it's a good thing. It's a wonderful thing. It's going to leave the industry much stronger. Yes, we must mourn the investors that got wiped out to zero, but even they are better off in the sense that they've been educated.
All the liquidation and bankruptcy events that followed the Bitcoin market downturn will prove to be healthy for the crypto market in the long run, according to Shark Tank investor Kevin O'Leary. O'Leary said that many crypto operators, particularly lending platforms, have never operated with such volatility before, and declaring bankruptcy is nothing new in the story of leverage, he added. These lenders were used to slow growth with Bitcoin at an $800 almost a decade ago.
So how do we protect ourselves even with public financials?
You own crypto without leverage, and you understand your counterparty risk. Don't worry, by the time all the litigation is over from all these bankruptcies, you'll know everything about everybody. Lawyers are really good at doing that, and there'll be tons of class action, if not just straight on litigation, to go after any assets they can get. And that is sort of, when a fish dies in the ocean, it goes to the bottom, and that protein is reprocessed by slugs. And I'm not saying lawyers are slugs. They have more than single cell proteins, but they know how to get the last drop of any value there, and they're going to get it. It's going to take 5 to 7 years, but all of this is good. So when I hold crypto, and I know it's very volatile, I have zero leverage in any of my positions because I know tomorrow morning I could wake up down 38% in any token, any coin, any project. And really, that's exactly what's happened. So, but if you put on leverage, you learn the very, very important lesson. You go to zero.
As the leading crypto asset made its way ahead of 60,000, these platforms became really aggressive in using leverage, O'Leary explained. In his view, a whole series of those actors will get crushed to zero over the next few months. However, he doesn't necessarily see that as a bad thing. The ongoing scenario is so good for the market because it educates the business models that aren't going to work. It's like taking a big spatula from the sky and scraping all the crap out of the market, he said.
Well, let's talk about that specifically, because I think it's a great topic, and for several reasons. Reason number one is people think that crypto, the entire sector, is going to get regulated all at once. That's not going to happen. The most likely scenario, and this is a personal opinion, but one I've been working on in Washington, along with others, is that we would like to get policy on just stablecoins first, because stablecoins represent a very powerful and efficient payment system. And we think we can get bipartisan support between both parties supporting the American dollar as a default currency for a global payment system. It's not going to be the Chinese yuan, it's not going to be the Swiss franc, it's not going to be the euro, it's not going to be the British pound. And the reason it would fall and default to the US dollar would be that that is the currency used to denominate most commodities. And so the challenge you have right now, and why there's so much pressure to solve this, is it's very inefficient to transfer US dollars over to Geneva, then put it into Swiss francs, and then buy Swiss Nestle stock or whatever it is you want to do over there. It's really slow, very inefficient, very costly, not transparent, and not easy to audit. And so all of that problem goes away with a stablecoin. Now, the proposed policy that you'll find in granular form in both the Haggerty and Toomey bills, and I've met with both of them, as many others have, this is very simple policy. What it looks as, it says, okay, for any stablecoin, an audit every 30 days. And any asset underlying, holding up the value of the coin or token, cannot have a duration of more than 12 months. Now, you've seen that policy before. It's called a money market fund, and you'll find it at Fidelity and Putnam and many other financial services entities that are FDIC insured. Circle, if it wished, that issues USDC, could become a bank. They could be FDIC insured if they wanted to, but they are sort of leading the pack with crypto in terms of payment systems under a stablecoin that has not broken a buck. So you've seen even Tether trades below $1. It's 0.999 right now. And so when you break a buck, you lose a lot of confidence. So what I'd like to see happen here is that we regulate stablecoins first because of their utilitarian value within the crypto universe, and that get done in this calendar year. And the reason that might happen is Toomey is retiring, and he is a driving force, as you know, on the Hill, and is really behind this momentum and this bill, and has lots of support from both sides of the aisle. So I think that's good.
An impending bearish crossover, a technical pattern theoretically suggesting continued weakness in the Bitcoin price, could be a trap for sellers and portend a bullish revival. A 3-day candlestick chart shows the simple moving average of the past 100 candlesticks is on the verge of crossing below the 200 candle SMA, confirming the first bearish crossover of these two averages since December 2018. Historically, the crossover has marked an end of a bear market and paved the way for notable bull runs.
Now, obviously, what happened to Luna is an example of what not to do. So again, a sad situation, billions lost, but a great education to the market. Algorithm-based stablecoins, I don't think we're going to do that again. I'd rather see something backed by US dollar or assets that are very liquid, that can have duration of less than 12 months. So that makes sense to me. So at the end of the day, the bad ideas get removed by the big spatula. And again, it's unfortunate for those investors that didn't think it through, but not all stable coins are alike, USDC being the leader currently. Now, having said that, if you go look at current yields across the spectrum of duration from 1 month to 12 months, it's only 50 basis points right now. So right now, USDC, while it hasn't broken $1, is not a great place to park cash, because you can do 1.2% in commercial money market accounts in US dollars. So at any one time, you have to manage assets as you always had to. I think USDC, when things stabilize and there's more demand for it, will probably have rates 300 basis points higher than 1%. but you just don't know. And when you were putting out loans on USDC platform, it would have been best to ladder them from 1 month to 12, so you'd still be accruing 3 to 4%. But everybody's learning. That's my whole point. That was a long dissertation about what I think is going to happen in stable coins. But if you're going to be in a stable coin, it's only a personal opinion, USDC is the one that has not broken a buck recently.
Crossovers between longer duration moving averages are known to be contrary indicators because they're based on past data and tend to lag prices. The market is often battered, oversold, and overdue for a reversal higher by the time the crossover is confirmed. Past performance is not a guarantee of future results. That said, history could repeat itself because the Fed's hawkishness or anti-stimulus stance appears to have peaked and traders are now pricing interest rate cuts for 2023.
So that's where you need management and compliance and total transparency. And so those who have opened accounts with Circle itself, managed it under corporate accounts, understand exactly what you just disclosed. But also the company is constantly monitoring its margin requirements and exactly what it's got and what it's holding. And if you have an account with Circle, you're getting a constant stream of information answering exactly those types of questions because they have their brand to protect. They also have that dollar strike value to protect, and they have their corporate accounts and account holders to protect. And they want to do that. They want to emerge from this successful, even though it's been tested with volatility. And I will remind you that recently it was disclosed that both Fidelity and BlackRock each invested $200 million in the Series F of Circle. That is a huge vote of confidence in the middle of all of this volatility. We're talking about the equity of the company. And so they're the most conservative money managers on earth, putting a bet forward on Circle becoming at least one of the regulated cryptocurrencies that are stable. And so at the end of the day, they have the risk too. We all have risk. But if I have to bet, I'll invest beside Fidelity and BlackRock, and that's exactly what I did.
So what do you think about leveraging crypto? Tell us in the comments. Also, don't forget to like and subscribe. I'll see you soon with the next video, and thanks so much for watching.